Well, silver's slingshot move has begun. Prices have surged past $36 per ounce, breaking through a technical pattern 45 years in the making, the largest cup and handle formation in market history. This breakout signals a potential trajectory not seen since the 1980 bull run, with analysts projecting triple-digit prices as monetary demand collides with structural deficits. The current rally, really diverges from historical precedents. While industrial consumption, driven by solar panels, EVs, and AI infrastructure, claims 65% of annual supply, monetary pressures now amplify the momentum. The U.S. debt-to-GDP ratio has reached 121%, matching World War II levels, while inflation-adjusted home prices exceed the 2008 housing bubble peak. Multifamily delinquencies and auto loan defaults now surpass global financial crisis thresholds, creating a perfect storm for safe haven demand. COMEX inventories have dwindled to 18-month lows as ETF inflows hit $2.1 billion in 2025, a stark reversal from 5 years of outflows. Hedge funds hold 85,000 net long contracts, the highest since 2020, while commercial short positions lag 22% below historical averages. This institutional positioning mirrors patterns preceding silver's 2011 surge, but with one critical difference. Physical market tightness has reduced paper market manipulation efficacy, with delivery failures up 42% year over year. Recession signals, they're flashing red. China's exports have contracted at their fastest pace since the COVID lockdowns, while United States job growth is stagnating at levels not seen since the economic freeze back in 2020. AI-driven workforce reductions, like IBM replacing 8,000 HR roles with automation, only add to the economic fragility we're seeing. Yet, silver seems to thrive in this kind of instability. Its dual role as both an industrial metal and a monetary asset puts it in a unique position to really capitalize on both the push for green energy and the ongoing currency devaluation. So, here's the scoop. Technical targets are pointing to $41.50 as the next resistance level. There's a 68% probability of testing $40 by October. Now, the 200-week moving average at $34, it provides some pretty robust support. But, the larger story, it lies beyond these levels. The 45-year cup and handle pattern implies a measured move to somewhere between $130 and $150, once $50 is decisively breached. All right, let's talk about what could really kick things into high gear. There are 3 factors that could accelerate this trajectory. First, we have COMEX delivery failures that could trigger physical settlement crises. Then, there's the potential breakdown in the gold-to-silver ratio below 60-1. And lastly, central bank diversification into silver amid the BRICS de-dollarization efforts. Now, as debt interest payments consume 5% of GDP and Moody's downgrades the U.S. creditworthiness, silver's role as a systemic hedge is growing undeniable. Retail investors, they're still on the sidelines for now, holding just 12% of ETF positions. This is a critical imbalance that could fuel parabolic moves when mainstream awareness finally catches up to institutional accumulation. The slingshot effect, folks, it isn't speculative, it's geometric. Fibonacci extensions align with 45 years of coiled energy in silver's chart, and when this spring releases, the resulting move will redefine precious metals markets for an entire generation.